Welcome back. I thought it might be a little fun to talk about one of the most widely used technical indicators. That's the Bollinger Bands, and it can be used not only to detect and identify the type of trend we have within the market, whether it's to the upside or downside, but also it indicates the relative state of volatility. And like myself, I'm sure many of you will download financial data, transactional data from time to time, and then we can begin to manipulate it. Well, it's very, very easy to do so and to actually plot out the Bollinger Band. So first we have our data, and what we'll very simply do is give ourselves a clean version of this data over here, and we'll transpose our dates on down. And then we're going to also need the closing prices. Now the first step is to calculate the 20 simple moving average as follows, and it's essentially equals average of the past 20 closing periods. That's the average price for the past 20 bars. Then we want to calculate the upper Bollinger Band as follows. The upper Bollinger Band is very simply the 20 simple moving average that we just calculated, and add to that the standard deviation of 20 periods, so the same period of time, times 2, because we want 2 standard deviations, and that's not written in stone. You can always change that as well, but the standard setting is 20 simple moving average and 2 standard deviations, and that produces for us the upper band. We can also produce a lower band in the same fashion. We can very simply say, okay, give me the 20 simple moving average, subtract from that standard deviation of 20 periods times 2, and that produces for us the lower band. And that's all there is to it. Now we take this data, we plot it on a chart, and we can see what it looks like. So again, the blue line represents the closing prices for Amazon.com. That's the stock we're looking at here. The orange line is the 20 simple moving average. That's the average price over the past 20 periods. The gray line above is the upper Bollinger Band, which is very simply the 20 simple moving average, and added to that 2 standard deviations of the same period of time, meaning 20 bars back. And the lower Bollinger Band is depicted with a yellow line, and that's very simply the 20 simple moving average and subtracting from that moving average 2 standard deviations over the same period of time. Now the Bollinger Band can be used in a number of different ways. First of all, it tells us whether the market's in a range bound or a trending state. In a range-bound state, you'll see the market, the blue line, the closing prices, it will tend to oscillate between the lower band and the upper band and go back and forth, crossing above and below the 20 simple moving average. However, when the market breaks out into a trend, the blue line, the closing prices, tend to remain between the 20 simple moving average and the upper Bollinger Band, or in a downtrend, they'll remain between the 20 simple moving average and the lower band. And when we have a trending market, what traders will tend to do is they'll try to buy near the 20 simple moving average and take profits as the stock goes up to the upper band. In a downtrend, traders will try to sell short near the 20 simple moving average and take profits near the lower end, near the lower band, and always trading in the same direction as the overall trend. When the market's in a range-bound state, where we expect it to bounce off the lower band and the upper band, traders may tend to buy near the lower band and sell near the upper band, at least until that range-bound state changes. But again, the formula is very simple. All we do is we take here, we'll say, first of all, the 20 simple moving average is this, very simply, the average of 20 periods. The upper band is very simply that 20 simple moving average plus 2 standard deviations of the same period of time, 20 bars back. And then the lower band looks the same way as well. That simple moving average minus 2 standard deviations during the same period of time. So I encourage you to download some stock market data and play with this formula on your own. And of course we can always manipulate it ourselves. So we can say, well, maybe I don't want 2 standard deviations. Maybe I want to play with a 1.5 standard deviation. So all we would do is change a 2 to a 1.5. Change all the cells accordingly. And then we can see how the chart changes as well. I look forward to seeing you back soon. We hope this has been helpful. Have a great day.